been talking to entrepreneurs and understanding their journey. But a very integral part of any business is sales and marketing. Because if you don't sell, you don't get any revenue. And if you don't get any revenue, forget profits and everything else. We have today a guest who specializes in sales. But that's not why we have him here. And we'll talk more about it. But first, let's welcome Pradipta Bora.
Hello.
Hi, thank you
Glad
for
to be
being here. And as you know, these videos are in collaboration with WSPL. Pradipta actually manages the sales of WSPL as well.
Yes.
So tell us a bit about yourself.
So yeah, I was born and brought up in the eastern part of India, northeastern India, Guwahati actually. Had a very quiet and sort of tranquil, you can say, childhood. Like when and it was pretty free flowing in the sense like you go and play anywhere you want. So some of those things were very, I think, memorable at this point. Post that, I actually moved out of like Guwahati to do my graduation at Kharagpur, and after that I've been working ever since. Did an MBA in between, but mostly I've been working in sales, revenue management, business development, new sales, working for different companies, a lot in the software and technology sector, and also I was partially in the product.
Predominantly sales.
Sales, yes, sales as well. Then in around sometime in last year, I started working on WSPL, looking after the sales for WSPL, trying to bring out a few new services for startups and mid-sized companies. So working to basically develop that business, make sure that there's revenue and predictable revenue sources there. And that is how it has been. So it's a long...
So I'll just ask, like everything that you have done, what would you say, what sells in sales?
I think in sales, there is a saying, also in Hindi though, जो दिखता है वही बिकता है. So what it means is that ultimately whatever you're selling or whatever the product or service or whatever it is, it should be the particular value for that has to be visible and accepted by the prospect or the customer.
Yes, unless somebody sees value, why would you?
Yes, and that is the role of the salesperson, to make that person see your value. Because within your company, maybe a lot of people think that your thing is very, very valuable. It should sell like hotcakes, but that is not usually happening. Especially in B2B sales, it's very different. So until you have done your job to make it visible to him, sales is incomplete, and maybe one or two sales might be due to like sheer luck.
Yes.
But only repeatable, predictable revenue can only come through a process where you are able to show.
And it's only repeatability that actually
ensures
that the company grows.
Yes. So once, and especially once, I mean, what is the you work with startups, so we know that once a company has a certain set of, it usually goes with like from product to idea to product, and then possibly a funding round, and finally maybe in a few years the goal is to be in an IPO or so, be in the markets, right? So at that time it is really critical, and which a lot of companies find it difficult to do, is because the scanner is completely on you. There's a quarterly sales and profitability that is reflected back, and everyone is seeing that.
Yes.
So the pressure is immense to produce that growth path, and executives are all measured on that.
Yes, everything starts and ends with sales, because unless that happens, like I said, nothing is going. I mean, nothing matters. Nothing else matters.
Yeah, you might have a great product, but until the sales part is looked after, the distribution, the as I said, acceptance of value from your prospects, that thing is not moving.
Right. And like I said, we don't have him here to learn about sales. Why we have him here is he deals in derivatives.
Yeah, so I've always been interested in the markets. No past history like from a family angle or anything. It's just that the sort of the movement in the markets, the sheer volume of transactions that is there used to like at least interest me initially. Like a lot of people, maybe I started around 10-12 years back. Maybe I made a few mistakes, lost some money here and there, and I did not lose money say on stocks per se, or got frauded, worked on tips or anything. I lost money say on mutual funds.
Okay.
So it is like really.
So mutual funds are not always a guaranteed profit.
No. All you see in the news and everywhere is basically the best performing funds.
Of course.
For the same 20 best performing funds in each category, there will be at least another 100 schemes which are not doing well.
Yes, of course.
saved the aberration of the last 2-3 years where it's been a huge bull run. Other than that, many of the schemes are underperforming the market itself. So you have to select well, you have to know what those fund managers are doing, and I think just putting a finger in the air and selecting.
Because SIPs and mutual funds are good, and they are a very good investment to have in your portfolio to start with investing in the market. But at the same time, just not any mutual fund or any SIP or anybody who comes up with a fund management house saying that invest in this fund and you'll get 50, 60, 70% return.
Yeah, so people are very interested in NFOs, new fund offers.
Yes.
But many new fund offers might even be very risky, like say investing a China thematic fund, or maybe like stressed credit. It can be anything. So NFO excites people.
Yes.
But it's not necessarily going to be doing well. And
they've already issued a disclaimer: mutual funds are subject to market risk. But people don't understand the risk involved, because they think if a mutual fund is managed by a professional, then it's somehow safe and he'll take care of the risk. But they don't understand that even the performance of the fund cannot always beat the market or be in balance with the market. It might sometimes underperform depending on the person who's managing it and on the assets that are involved, because mutual funds in turn invest in shares.
It does.
So it all has to do with which shares they have picked for their fund.
But a few other things to note is that not all mutual funds are equity focused.
Yes.
There are things like balance advantage fund. There will be a debt fund as well.
Infra-oriented fund.
That will still be equity. Yes. But then there are debt and sort of others which operate in corporate debt as well. Debt itself is of many flavors, right? You have government debt, which is sort of guaranteed, but you have then corporate debt, commercial paper, a lot of it. So mutual fund is a vast area. So if you explore, just because someone has told that market is booming, go and invest. I think there's a lot of research or understanding that needs to be done. And at the same time, you also have to understand that maybe some of these mutual funds won't perform in the near future or this thing. What is to be noted, and say from empirical evidence, historical evidence is kind of gospel truth right now, would be that possibly the market in a 10-year range pretty much will give you decent returns.
Yes.
So that can be a sort of starting point for everyone.
And you can always, you always have a list of funds which are performing well currently with a diversified portfolio or may sort of suit your risk appetite. So somebody can actually go and choose those funds rather than investing in any random fund.
I would suggest that if anyone is just starting into mutual funds, they might look at like the best performing funds and see what those, and also please know your fund manager, because I believe that many people who invest in SIPs do not know who the fund manager is, what they do and this thing. So try to follow that. Maybe that AMC itself should also be followed.
Reputed,
So that should be one aspect, and see how their performance are. They might have managed other funds in the past. If you have an idea, then go and look into those. So dig a little deeper than the person.
And also monitor your funds. If your fund is not doing well, and the market is otherwise performing better, then think of changing your fund. Or of course, there are a lot of things involved with shares they have invested in. If you say large cap, but just go and have a look at what shares they're investing, how they're performing, and whether what performance they have given in that particular sector beats the industry, the company's performance. So all of that things has to be monitored. Just blindly, like these days we have influencers who say, start with 10,000 in this SIP and you will get 10 crores at the end of 10 years and 25 years. You have to see whether you are on that path to 10 crores or not. Actually.
Yeah, so a big assumption in those sort of influencer claims is the growth rate or sort of rate of return. So most likely they're assuming around 15 to 18% per annum. A CAGR of 15 to 18% over a 10 to 20 year period is a huge ask.
Yes.
Because it's a consistently 15%. Approximately your money doubles in 7 years. So that is a big ask. So that is where you have to think whether this is really possible repeatedly, or is it going to be some sort of and anyways this will require a little bit of monitoring on your part. And another aspect is what has done well, at least last 30-40 years, is sort of index funds, right? So index funds just monitor the index. So in India we have the Nifty 50, the Sensex. So there are funds which directly invest in the stocks which comprise of those index.
Right.
So if your bet is on the overall India economy, maybe that could be one thing that you can start out with. And usually it will be large caps. So gives you some margin of safety.
Right. Now we talked about mutual funds, but I have a group of people, and somehow I also got into that group a couple of years ago, where I felt that rather than investing in a mutual fund, which again diversifies and invests in a lot of companies, why not choose specific companies and invest in them?
Yeah.
Like for a longer term. Say you believe in a company, you think that the company has done well in the past, it has given good returns, its ROI and everything is good, its PE ratio is good, and you decide to invest in that company. So rather than doing an SIP, as like an SIP, I can just buy the shares of the company and it will do well. And it's not just me, a lot of people now, there's been an influx of retail investors directly into the market. Now we'll go into it a little later, but for now, just whether investing directly in stocks is somehow better than mutual fund, because you are, that is within your control and you're managing it. But at the same time, you're not a professional, you're not investing 100% of your time in that, and somehow you might miss something. So which do you think is a better?
I think it is all about like how much time and energy you can devote, right? So most likely the people who think this way will be in a job, have to devote around, so include your travel, everything, maybe around 10 to 12 hours every day. So after that, it is all about your willpower and sort of your energy, devotion that you have to finally go and again study and understand those businesses which you think are good, right? So that is usually, that amount of time is not usually available to a professional who is not directly working in the market. So in that case, you are kind of deferring your responsibilities of really investing to another individual, which is in this case the fund manager, right? If you really think, and to build that knowledge takes a decent amount of time. You can do it with a job, everything can be done, but it will be a very hard fought victory in that sense, because for many years you might have to do studies, maybe whether some losses.
And sometimes you do not even have access to those kind of research or industry sector reports or some information that they have, because they're actively involved in the market.
Right, and also some events may occur which you were not able to react to in a quick manner. Due to that, maybe the opportunity to either exit or enter a new stock, you lost. Right. So many of these things, since it is stock prices are affected by a multitude of factors, due to this, it is best that maybe the professional
and rest.
Yeah, in any case, you are free to do research on the mutual fund unit stocks that they own, right?
And you're supposed to monitor it anyway.
Yeah. So if you have an idea, like maybe IT professionals can definitely think that maybe I know about the IT sector. So then they can think of maybe a thematic fund or maybe a few stocks in the IT sector when they believe in the next 5 years.
It also depends on your risk appetite. If you say you're not doing it for a long term, you're doing for short term, and you think that you can make quick money, then it is not. I say this stock market is not for the faint-hearted, because sometimes you might expect a profit, but it will go sideways in a way that you have not expected. So
sideways or even 10% down due to news.
Yes.
And then 90% of the short-term players will not have the ability to weather that sort of loss. It might even bounce back the next day.
Of course.
Like Infosys, once there was a whistleblower thing, and I think it dropped around 18% or something within 2 days. But again, it came up once the whistleblower thing was. So maybe as an investor, you won't have the gumption to weather that fall.
Right.
So due to those things, if you have I would say at least a portfolio of stocks, that might help you to
have a portfolio of stocks. But if you're not actively involved, you majorly invest in mutual funds. Monitor your mutual funds, nevertheless.
Yes, and I think there's one book called One Up on Wall Street by Peter Lynch. So what it talks about is basically investing in the stocks that you need. So as I said, IT professional may be knowing about the IT stocks, right? Or if he's very focused on the financial services vertical, maybe he knows a little bit more about that as well. So wherever your lane is, you can think of going deeper into that lane and then do a little bit of it. Because you might encounter some news while you are working. So those
you might not react to it. You might not get time to react to it. So now talking about influx of retail investors, I have seen a lot, and it is a good thing that a lot of people are investing in the market and entering the market. But do you also think there's this FOMO that is causing most people to enter, because they feel that they are missing out on making some quick money and big money, whereas others in the markets are making some huge amounts? So Everybody is talking about crores these days. Everybody is talking about 50-60%. And I know, growing up, since I've been involved in the market, though I am not a trader, but somehow I have always invested some portion of my income. So I have seen the market grow, I've seen the market fall, and I've seen it, going in ways that probably we had not expected.
Yes.
But these people who enter and it's not that they're entering the market, they're entering the market with half-baked knowledge based on some influencers, some article in the newspaper or some social media person telling them that, there's big money to be made.
Yes.
So is there a FOMO which is making
I think you have to look back, right, at think of like the presence of finfluencers before COVID. You might have maybe a technical Guruji sort of YouTuber before. You might have known some of those things, maybe one or two others. But this finfluencer community where it is talking about stocks, the explosion has been since COVID.
Yes.
And the reason has been always that still now it is because people during COVID for the 2 years had a lot of time on their hands.
Yes.
They thought maybe we should do something else. So they stumbled upon the market.
Also they pooled in. I feel that, and none of the people that I know agree with me, but I also felt that COVID made them, not spend their money in a way, and so everybody somehow had a pool of money.
Yes and no, right? Because some people in COVID lost a lot of money due to like sickness, whatever.
Sickness and yes,
but I think it is more about time, because you thought maybe I have some more time during the day. I can do something else as well. Anyway, market. Look, if you are in the office, you are able to glance at the screen maybe 4 or 5 times during the day at most, right? And even that will not be continuous. While in COVID, during COVID, you were able to have another screen open, maybe a laptop or whatever, and at there were 45 lakhs Demat accounts opened just during the first 3 months after COVID. Right? So I think every month after that is by almost 8 to 10 lakh Demat accounts. Now this craze is why? This is combined due to like time on people's hand, as well as serving those people's need for knowledge is served by these influencers. Again, not necessarily knowledge, but just information. So there were a lot of channels which would prescribe do this, do that, do derivatives, do macro stocks, micro cap stocks, this, that. So a lot of people burnt their fingers into that, in that. Right? But still there's a community that is growing easy information.
Easy information and easy profits, but it's always a gamble.
It is, and also I think the reason is this is a bull run of the likes which is not since say 2007. From 2005 to 7, the kind of bull run that was there in the US markets, and due to that in India as well. There's easy liquidity. Many of people who would be watching might not understand how that impacts the market, but ease of or the cost of funds being low helps to funnel more and more money into the market. So that is exactly what has happened.
And just in March, when they were supposed to balance their books and there was a little less liquidity, you can see the market fall. There was
you can say that sometimes.
There is the markets are going down a bit, but then again it's a sideways market currently, so it will go up again and come down, and that will happen. But you can see that there's somehow a fall, and it impacts retail investors mostly because small and mid caps get affected. Let's not get into technicalities. Let's just stick to the fact that yes, the market, the people who are entering the market are not entering with complete information. And they don't do the research because they are, like you said, it's quick information.
It is quick information.
So, a lot of people actually talk about PE and, they talk about candlestick pattern, and it took us some time to understand those concepts. These people throw those concepts as if they are, born with it, but the problem is they don't understand. It would have been a happy coincidence if they understood it all and talked about it, but they don't, and they enter the market, they get some money. But like I said, it's a gamble. So then they lose big. And when they lose big, they don't understand and they blame it on, say, influencers or market or economy or so many things. But, somehow I feel there is a gap in knowledge.
It is, because I think the influencers also have their income is primarily through joining their paid groups. Right? Be it on YouTube or anywhere else, Telegram and all that stuff. So because of their need to earn regular monthly subscription from their users, they feel the need to keep giving ideas and stocks and this thing. So that is unhealthy, because if you think about investing, you're supposed to hold it at least for some time.
Yes.
Even if it is, say, trading for a short term, possibly that short term is at least a month or maybe more. But these influencers will give like stock tips every week or whatever.
Yes, yes. There is a breakout happening, so within
Yes.
2-3 trading sessions, the stock will go up.
Yes.
But there's a chance that the stock might fall because there might be something in the market, and for that you're not ready because you've somehow. There are people I know who borrow money and invest.
Yes, yes. Actually, even now there's been a recent crackdown, but even HNIs were actually using money from NBFCs to put into markets.
Yes.
If you recall the infamous Ashnil Grover case, that was actually, or how it started with Kotak and everything. That was basically he was asking for IPO financing from Kotak Mahindra Bank.
Yes.
So that was what he wanted 100 CR to. So that in the last 3 years has been the case, because you think that your money will just sprout, you will have a 3x on listing, all of those things.
Yes.
So those things are there. I think also it has been helped by the raging bull market, right? So every month or every there's not been a 6-month period in the last 3 years where there's been a drop.
But the permanent thing about the market is nothing is permanent. So even if the bull run is giving people money now, I think there has to be a correction.
Yeah.
At some point there will be a correction, or there might not be a correction at all, and this might keep going, but at some point it will come down, or it might go up, and there might be a point where you need the money and you can't take it out of the market. It has happened to me, it has happened to a lot of people, but at the same time you can just tell them that they have to be careful. Whether they're careful or not is completely discretionary. Actually.
Yeah, I think people don't realize that in investing itself you need to go deep enough to have some sort of style of investing, right? You either have a small cap, this thing, you invest into sort of distress situation, something that you will be able to have built a knowledge over time. In trading, it is similar. You have sort of system with certain edge which works for you, and you keep repeating it over time. So I think most people will never get to that and develop that, and that is where these sort of temporary failures and repeated coming into the market, emptying their pockets and again coming back keep happening. That is the reason. So try to understand possibly what is behind all this. Why are there? Definitely there are some people making money. Why is that happening? How does that work for them?
They put in effort, they put in research, and there's a lot of knowledge behind what they do.
Yes, and it's what market has been since, the New York Stock Exchange has been there since 1880s, right? So it's a huge, 100 years plus knowledge base, types of things that have happened. Then technology came, you have a click of a button, but still there is similar things happening. So if you understand those things, or try to understand at least, you'll be ahead.
Yes, I have friends who have been dealing with derivatives for the last 5 years, making losses for the last 5 years, and believing that this year they're going to end up with profit, and with a turnover which goes as high as 1 crore and 1.5 crores. So to be able to do that.
Yeah, leverage in derivatives in market is now almost zero. But still, what people don't understand, that derivative itself is a levered product.
Exactly.
So an option for the Nifty 50 available at 100 rupees actually controls 50 shares of Nifty. Nifty today is at around 8.5 to 9 lakhs. So it is 9 lakhs into 50. So with that one lot, you are controlling around 45 lakhs of actual notional value. So I think people don't understand that. The reason why an option value goes from 20 to 100 so quick is because it is compensating for that amount of change in notional or the futures value, right?
Yes.
So that is exciting to some people, but I don't think that is going to.
They just know that they have to buy a call option and a put option. They sometimes don't even know what a call and put is, but they do it nevertheless. So if you have easy information, please be careful about what you're doing, because ultimately, even if you're making money, it's a gamble. And in a gamble, you might get lucky sometimes, but not always. So the day will come when you lose it, and maybe you don't, but if you lose big, then it will just wash away all the profits that you
Derivatives is also one place where you can lose more than your capital.
Yes, you can.
So you have 50 lakhs capital, but you might end up losing 80 lakhs.
I feel this is my personal this thing. If I'm investing in a stock, I believe in the company, and even if it is not doing well or it falls by say 5-10%, I can always hold to it.
Yes.
I can hold on to it because I believe in the company, and somewhere down the line it will go up again, or I make my money.
Yes.
Even if I don't, invested in the company, I'll get a dividend and some kind of return I'll be able to make out of my money. But when it comes to derivative, you lose it and you lose it all.
No, even in stocks, I think you have to be careful of the micro cap
course,
sort of
yes,
stocks.
yes.
Yeah, I mean, there are areas or pitfalls everywhere in the stock market. And there are people who are willing to do a lot of shady things to take the money. Right?
Yes.
So it's a money market.
These days they form WhatsApp groups. I don't know if you know it. I came across one such group where the administrator of the group claimed that I am from JP Morgan, and what we do is we collect money from everybody and we do bulk trade, and so we give a portion of shares to all of you. Now, like it in its very essence sounds shady and a sort of a scam. But there were people in the group, there were people who were claiming, of course, their own group, who were claiming that yes, we have made money previously. Yeah. But JP Morgan, Goldman Sachs coming and, doing this on WhatsApp is a red flag in itself. JP
Morgan actually does not work in the Indian markets. It is only the investment banking part where they work.
See, but people do invest and people do lose money. So, I don't know. But
I think, people have to be careful of like the markets in terms of what they're doing, and think about if they've made past losses, maybe take a break and think about really going slow. If you go slow, invest low amount, you are not able to lose large amounts. If you do 50k for a year, it is very difficult to do. So going slow is the antidote to all these losses actually.
And there is no quick money in the market. There's like every time you hear quick money and quick returns, just think that from the past, from ages onwards, everybody has advised that quick money is actually not a thing. But is there a right time to enter the market?
There is no entering the market, right? So people think that, okay, now I will put in 10 lakhs and then it will become. There is not like right now you might have the knowledge to actually invest that 10 lakhs. So if you are learning about the market, you are there in the market, even if your money is not there. So there's no right or wrong time. You put up a little bit of money and very small amount of sort of token money just to sort of invest in a few stocks and see how they do, right? There's no right time. Maybe they will become zero, which is also still okay, but you didn't lose big, which many others have done. So there's no right time to enter the market. It is all accumulated knowledge over a period of time. The first 4 or 5
It's basically a frame of mind, not whether the markets are at their lowest or the highest or
in any case, if you do the average cost or what is known as SIP, you're not really bothered about the markets going up and down. So your average returns are over a period of many months. So in that case also you're already taking advantage of not looking in the markets or thinking about the market cycles regularly.
Right.
So you're always investing.
But also, do you feel like you said during COVID, 45 lakhs accounts were open in the first 3 months. So like considering the population of the country and the amount of demat accounts, the number of demat accounts that we have, don't you think there is a huge potential also amongst the retail investors in India, because a large chunk of population is still doing postal savings or fixed deposits and recurring deposits. So this FOMO will ultimately catch on to them also, and they will
not necessarily all of it is FOMO, right? So in US, I think household saving, I think 60% or 50% is in the equity markets.
Right.
So again, that's also a risky thing. So if it goes up, it's all well and good. But in 2008, a lot of the people lost their 401k savings.
Yes.
In India, you are not necessarily investing your EPF into the markets. What does that do? That means some kind of a basic amount you're always getting at the end of the. So if that amount is going into the markets or more amount is coming into the market, more people are there, yes, the market will become larger. But that also means the economy itself grows big because there are more companies that are going to be working in different facets, maybe more people. So I think that way, rising or affluent India will invest more in market. That is a given thing.
But that won't necessarily mean that you will get a profit in the market.
No, you have to again do the same.
Overall, grow and invest in the company specifically.
Yeah.
Company or the sector specific.
Yeah.
So now we have seen a lot of IPOs happening, because earlier there used to be hardly 1 or 2 IPOs in a year. Now we have that kind of IPOs, say in a month or so, and a lot of new entrants are entering the market, and a lot of influencers again, and a lot of social media talk is about investing or applying in these IPOs, because they feel that their listing is always going to be higher at a premium and they're going to make money. But there are also some veterans who suggest that, these IPOs are not always going to do well. So there is a gap, or there is a divide in the market as to whether to invest in the IPOs. But for retail investors, do you think it's a little risky to invest in an IPO thinking that the listing will always be at a premium, which has not happened.
I think there are two facets to it. One is that since the sheer number of IPOs are there, similarly there is a huge demand for these IPOs. So consequently, even though there are a lot of IPOs, many people do not get a listing. Right. So that is saving them in some sense. However, there are many IPOs not because the companies suddenly have thought that, now we are a right size to raise money. It is because basically the fundraising team part has become a little bit easier due to the bull run. So that is their hope as well, the promoters. So you have to understand that many IPOs are coming due to the ease of fundraising and why many of them are listing at higher gains. And IPO feels like a gamble actually, because you put in money and then on the day of the listing you get a 30, 40%, 50%, and some even 100% listing. So it feels like a really what is known as satta, right? So you put that money, it is that what is that called, in a pot, and then it comes out, and 3x will come out, something like that. So please don't go for that. I think nowadays it will again slow down slowly. And possibly, and in IPOs, many of the companies are unknown. So very difficult to do research as well on what they actually are.
So one thing I got from the conversation is that people shouldn't think or shouldn't gamble with their money, because stock market is not a place to gamble. Firstly. And secondly, if you do not have the risk appetite, do not invest with borrowed funds in the market.
Never borrow.
And thirdly, always research and know a little bit about where you're putting your money. That's the basic of money management.
So go slow always. Slow will help you to understand what is going wrong. The idea of quick money and money for certain expenses that you might have will make you lose money.
Yes. You cannot think that you invest money in the market and it will give you a return monthly to take care of your expenses. That's not how market
and market will give you 15% CAGR for some good stocks, but it is only a CAGR over 15-20 years, not every year.
And it is not consistent.
It is not.
The average might be 15%, but it might fall and rise in the middle.
India's greatest investor, Rakesh Jhunjhunwala, held one stock for 35 years.
Wow.
So that is the reason that he is so rich.
Yes. Thank you, Pradipta.
Thanks.
It was a pleasure talking to you and understanding the markets. And
Thanks
we do more of this. Stay tuned and subscribe to the channel if you've not done yet.